Okay, we're going to pick up where we left off last time and start up here with looking at when borrowers make a payment. So let's get started there. When borrowers make a payment, the payment less the servicing costs, we talked about that last time. If we have, for instance, this 4.5% interest rate, average interest rate on all the loans in a mortgage-backed security, and the pass-through rate is 4.125%, that difference between those two numbers, the 0.375%, also we'd call that 37.5 basis points. That is going to be going to the servicer. So the payment less the servicing cost goes to the holders of the securities. It would go to the security holders based on what kind of security they had. So there's a variety of different mortgage-backed securities, but for the sake of this class, we're going to assume that there's only one class, a very simple thing where everybody gets a pro rata portion of the payments. So that's a fancy way of saying if you owned 1% of the securities, you would get 1% of all the payments that are made. If you owned 2% of the securities, you would get 2% of all the payments that are made on these things. So again, we're keeping it simple here. This is much more complicated. All right, let's move on to a couple of these types of securities. There's Ginnie Mae and Fannie Mae. Actually, these aren't securities only. They're also government agencies that are guarantors of loans and kind of help facilitate lending in the U.S. So Ginnie Mae, Government National Mortgage Association, this is a guarantor of mortgage-backed securities. They guarantee the timely payment of principal and interest for loans that are FHA or VA backed. That is to say, if you go through these federal programs, get your loan, those loans are then pooled together and used to create Ginnie Mae securities. So the government is the effective guarantor of these things. So they're very safe. Buyers of these securities like them a lot for that safety and for that government guarantee. Fannie Mae, the Federal National Mortgage Association, these are secured, or this group is used, God almighty, this group creates, Jesus Christ. This agency was created to provide a secondary mortgage market for loans. They also guarantee the payment of principal and interest on mortgage-backed securities that were packaged by them. These are going to be the conventional conforming mortgages. So they are typically going to be pooled and issued and guaranteed by Fannie Mae. Private conduits, these are large banks that issue home mortgages. They package them up and sell the securities. These are frequently going to be things that are either don't quite meet Fannie Mae and Ginnie Mae requirements. Perhaps they're jumbo securities. We talked about those. Those are frequently, or those are always going to have to be private label if they're jumbo and they get securitized. But these are done by individual banks. So big banks would do private conduits. Well, let's move on to 4 channels of lending and talk about that and see if we can move through the rest of these notes here in this second video. So 4 channels of lending. First, the portfolio lenders. We've talked about those. They lend and they hold on to securities. That's their defining characteristic. These are most likely going to be community banks, so savings and loans or credit unions. So many of these loans are going to be adjustable rate mortgages. And those are very frequently going to be held on to as portfolio loans by these smaller banks. And that helps the banks with their interest rate risk management. We talked briefly in a previous video about that, where you have this kind of you can have this mismatch between assets and liability interest rates. If banks are getting money from customers, they're paying out an interest rate, and they're making their loans long-term. The savings rates are short-term. So in a world where interest rates rose rapidly, banks could be in deep trouble because they've made loans that have fixed interest rates, and they're going to be having to pay more and more interest to borrowers to attract their money, attract their deposits. So that can create a problem. Adjustable rate mortgages kind of address that problem because adjustable rate mortgages, the interest rates and the loans would go up as the interest rates in the environment as a whole went up. FHA, VA, those whole things that get packaged into Ginnie Mae securities, that would be another channel of lending. We have the conforming conventional loans. Those get bundled into Fannie Mae securities and Freddie Mac securities, actually. So these are government-sponsored entities that back those things. And then finally, the non-conforming conventional loans. Those would be the private label. So we've kind of talked about each of those 4. So we'll move on here. Most of these channels, and this is kind of important, you never really see this as a borrower. You don't really know what's going on behind the scenes, behind the curtain. You're just getting your loan from a local bank, perhaps. Maybe from an online lender like Rocket Mortgage or Quicken Loans. But you just deal with the bank, your broker, and get your loan, and then things kind of behind the scenes get taken care of. The loans get pooled, warehoused, securitized, sold on, and then you get a thing in the mail that says, here's where you're going to be making your payments from now on. So there are many loan programs and many lenders out there available to borrowers. So it's important that you shop aggressively, not just for interest rates, but also for fees, points, and any other kind of characteristics of your loan. So yeah, it's not a one size fits all. You definitely don't want to just go to the bank that you've had or your parents have had for a long time. You want to shop around and really understand what's going on and try to get the best deal. So let's wrap up this video by looking at the lending decision and really looking at underwriting. So how a bank determines that a borrower is sufficiently creditworthy to give them a whole bunch of money. So there's 3 big C's in underwriting: collateral, creditworthiness, and capacity. Let's talk about collateral. In the case of a mortgage loan, the house is the collateral, and an appraisal is necessary to support or prove that there is an asset that is worth enough to support the loan. So if you're buying a house for $300,000 and getting a loan for $200,000, that's going to feel good to a bank because we know we have this asset that's worth $300,000 that's backing our loan of only $200,000. We've, I'm not sure if we've talked about LTV in this class, loan to value. I feel like that's my other class, but that's going to be an important measure of the risk. If the value of the asset is worth a lot more than the loan, then the bank is going to be feeling very good. If the loan and the asset are equal, that is to say your loan is 100% of the value of the asset, banks start to get a little bit skittish at that point. Creditworthiness is a very big deal. This is an evaluation of the borrower and their past behavior with credit. So the very common way of assessing that is through a FICO score. So a bank will pull your FICO score, they'll get your credit scores from the 3 rating agencies and look at that, and frequently it's simply a mechanical thing. There's no thought by a human involved. It's just a number that comes out, and they're going to look at that and use that to assess your credit worthiness. And they may call you a AAA borrower, a AA borrower, an Alt-A borrower, somewhere between prime and then subprime would be the lowest. So if you have a 560 credit score, you had a number of late payments and maybe a bankruptcy 8 years ago, 7 years ago, stuff like that, you're going to be a low credit borrower. If you have excellent credit rating, you're going to be a high rated borrower, perhaps a AAA, and that means you're going to get the very best interest rate. So the interest rate that you ultimately get, or even whether you get a loan, is going to be determined by your credit worthiness and also your capacity. So this is your ability to pay. There's 2 big ratios that lenders look at. One is the housing expense ratio. So that's PITI over GMI. Lots of acronyms there. Let's talk about what those mean. PITI is principal, interest, taxes, and insurance. And those are the 4 biggest components of your house payment that you make every month. So principal and interest is just paying back the loan. That's the kind of the amortization payment that you make. We did that math in the previous chapters. Taxes and insurance are also required payments. You got to pay your property taxes every year, and insurance is required, especially if you have a loan against your house. So in case the house burns down, the lender will get their money back. So those are all required. You got to make those payments if you're going to have a house. So we want to put in all 4 of those pieces, not just the PI, the principal and interest, but we also need to take into account the taxes and insurance. And then we're going to divide that by the gross monthly income. That's the GMI. And as long as that ratio is 31% or less, then you would meet the criteria for the housing expense ratio. Another way of saying that is about 1/3 of your money is going towards your housing. Just under 1/3 is going towards housing. If you're well above that, say you're 40%, 50% going to housing, banks are going to have a little bit of heartburn giving you a loan that's going to put you in that kind of situation. The next ratio is debt to income ratio. So that's going to be principal, interest, taxes, and insurance, and any other long-term obligations that you have. So any other debts that you're paying, if you have a car payment, if you have student loan payments that you're making, if you got credit card payments, the bank will bundle all those together, divide those by your gross monthly income, and make sure that you're not paying more than about 43% of your total income towards all of these debt obligations. Again, if you're above that number, they're going to be leery of giving you money. You're going to be higher credit risk. Certainly you'd have a higher interest rate if you're even able to get the loan at all. We're going to pick up with this example in the third and final video, and I'll see you then.